If you're running a small business here in Canada, you already know the deal. Getting the right piece of equipment can literally change everything. It's the key to unlocking real growth. But how do you pay for it without completely draining your cash reserves? Well, that's exactly what we're going to dive into today.
It's the classic catch-22, isn't it? You know that new truck, or that upgraded kitchen, or that faster computer system is exactly what you need to scale up. But that huge upfront cost, it just feels like a massive wall. If you're feeling that, trust me, you are not alone.
And there's a huge reason why that wall feels so high. Check out this number, 72%. That is the percentage of small business loan applications that get flat out declined by traditional banks. It's a crazy high number, and it just goes to show how tough that old school route can be.
So what do you do? How do you get past that hurdle? Well, that's our game plan for today. We're going to look at the 4 main financing paths you can take. Then we'll throw them into a head-to-head showdown. I'll give you some insider pro tips, and by the end, you'll have a super clear framework to make the absolute best choice for your business.
So yeah, this is really the heart of the problem for so many Canadian entrepreneurs. You need the gear to grow, but the most obvious place to get the money, the big banks, is often a dead end. That's the growth hurdle we're going to learn how to leap over right now.
But here's the good news. The bank is not the only game in town. Not even close. You've actually got 4 main roads you can go down, and each one has its own set of pros and cons. Think of it like 4 different trails up the same mountain. Let's check them out.
First up, the one we all know, traditional banks. Now, the big carrot they dangle is, of course, those lower interest rates, usually in that 4 to 7% range. But getting that rate, it comes at a cost. We're talking a slow, painful approval process, a mountain of paperwork, and you better have a picture-perfect credit score.
Okay, path number 2 is leasing. This is an awesome option for getting equipment in your shop fast, with very little cash up front. You get to use the latest and greatest gear right away. So what's the catch? Well, the main trade-off is that you don't actually own it at the end. It's a rental, and the long-term costs can add up.
Path number 3 takes us into the world of online lenders. Their big, flashing sign says one thing: speed. I mean, you can get approved in as little as 24 hours, but all that convenience, it definitely comes with a higher price tag. You're going to see higher interest rates here, easily 8 to 15%, and sometimes even more.
And that brings us to our 4th and final path, financing specialists. These are companies that do one thing and one thing only: equipment financing. They really try to give you the best of both worlds, mixing the speed of an online lender with payment plans that are way more flexible and actually designed for how a real small business operates.
All right, now for the fun part. We've met the 4 contenders, so let's line them up and see how they really compare. When it comes to the stuff that actually matters, speed, cost, flexibility, which path comes out on top? Let's find out.
Wow, okay. This right here tells a huge part of the story, doesn't it? Look at that difference in approval speed. A bank could leave you hanging for weeks, maybe even 2 months. That's long enough for a huge opportunity to just vanish. But a specialist, they can often get you an answer the very same day. For a business owner, that kind of speed is an absolute game changer.
And this is such a critical piece of advice from Conchetta Farina. It's so tempting to just laser focus on the interest rate, but she's reminding us that the lowest rate isn't always the best deal. You have to look at the whole picture. How much of the cost will they actually cover? What do the payments look like? What do you have to put on the line to get the deal?
Okay, this table really lays it all out, nice and clear. You can see the big trade-off immediately, right? The slowest option, the bank, has the lowest rates. The fastest options, like online lenders, have the highest rates. Leasing gives you flexibility, but no ownership. The trick is to find that sweet spot in the middle, that perfect balance of speed, cost, and flexibility that works for your business and your specific situation. So, now you've got the lay of the land. Let's move on to some pro tips. This is the kind of insider knowledge that's going to help you navigate this whole process like a true expert and make an even smarter choice.
You're probably going to hear this term thrown around, a conditional sales contract, or a CSC. The easiest way to think about it is like a rent-to-own deal for your business. The best part is you get to put that equipment to work immediately, making you money while you're still paying it off. Then, once you make that final payment, boom, it's all yours.
Now, here is a huge myth that we absolutely have to bust. A lot of people think financing is just for brand new, shiny equipment, right off the showroom floor. Nope. You can totally finance used equipment, even if you find it from a private seller online. This can save you a serious amount of cash.
Check out how simple the process is for used gear. Seriously, you can apply online in just a few minutes. You'll often get an answer within 24 hours. And then you're good to go. You get your equipment and you get right back to running your business. It's really that easy.
And you're going to want to remember this one come tax time. In Canada, we have something amazing called the Capital Cost Allowance, or CCA. So what does that mean? Basically, it lets you write off a chunk of your equipment's cost every single year. The bottom line? It lowers your taxable income, which means you pay less tax. It's a pretty powerful perk.
Phew, okay, we have covered a ton of ground. Now it's time to bring it all together so you can make the right call. See, my goal here isn't to give you the answer. It's to give you the right questions to ask yourself.
So it all boils down to this. Ask yourself, how long am I actually going to use this thing? If it's only for a couple of years, maybe leasing is a no-brainer. How fast do you need it? If the answer is like yesterday, then you know the bank is out. How is this going to affect your day-to-day cash flow? And hey, if you run a seasonal business, do you need payments that can adapt to that? And finally, the big one. How important is it for you to actually own it in the end? Your answers to these questions will point you straight to the right path.
I really want to leave you with this piece of advice, this golden rule from John Elliott. Keep your cash in your business for emergencies. This is the whole point of smart financing. It's not just about getting the shiny new toy. It's about protecting your cash so your business can handle surprises and jump on opportunities when they pop up. So as we wrap this up, just think about this for a second. What is that one piece of equipment that you know would completely change the game for your business? Whatever it is that just popped into your head, now you know how to get it. And it's probably a lot easier than you thought. Thanks so much for tuning in.